the gap between real GDP growth on a year-over-year basis and real GDI growth on a year-over-year basis has never been this wide. It was 2.5% in the first quarter, and we thought, okay, this will close. This is going to, we're going to find out, how weak is weak when the second quarter is reported. Well, second quarter GDP was in real terms was up 2.5% on a year-over-year basis, and the GDI year-over-year growth rate in real terms was down 0.5%.
The next Federal Open Market Committee (FOMC) decision is due on September 20th and will also include an updated summary of economic projections. The CME Fed Watch tool shows markets are pricing a 93% probability of no change to the Fed funds rate at this meeting. Europe is facing a stickier inflation problem than the US, with investors and analysts increasingly warning of the risk of transatlantic divergence in both economic fortunes and the responses of policymakers. After surging to multi-decade highs last year, consumer price inflation in the US has fallen faster and now stands at a much lower level. Annual growth in wages for workers in the UK and many Eurozone countries has overtaken the pay rises of their American counterparts in recent months. Cathie Wood now goes into detail about the economic indicators, market settlements, and various market signals. Stay tuned, hit the like button, subscribe, and drop any comments below. Enjoy.
The non-farm payroll employment was a little better than expected at face value or at first glance, 187,000. But when you include the revisions, down 110,000 in the last 2 months, that netted out at 77,000. That's quite weak, actually. Now, the household survey, again, something for everyone in this report, was up 222,000, but the unemployment rate really shot up from 3.5 to 3.8, still low, but a big increase over 1 month's period. And so that was somewhat surprising. The participation rate continued to move up, 62.8%. And many commentators thought that was a bullish signal. And it is, more and more people participating. But if we're right, this also could be a signal that the consumer is tapped out and needs to either get a second job or another person in the household needs to get a job. So that could be partly what's going on right now, and we suspect that is. Average hourly earnings were up only 0.2%, so that's 2.5% at an annual rate, though still up 4.3% year over year. If productivity is increasing as we think it is, that means that on a year-over-year basis, the unit labor costs, or real wage gains in this case, could be below 2%, and at an annual rate basis could be close to zero, so very low inflationary ramifications. I know that a lot of people are focusing on some of the negotiations taking place and some of the wild and crazy settlements taking place, and I'll get into that in a moment. But we think that's going to backfire on those companies. Hours worked, the average work week was up 0.1 hours, and so that kind of takes the edge off of a very weak employment growth number. Temporary help continues to go down, though. Those jobs are going down. And so it's all coming into place. It's taken longer, certainly, than a lot of us expected, but it is all working out, I think, the way we have expected. Speaking of earnings reports, it is shocking to see, first of all, on a year-over-year basis, earnings are down, but the top-line growth of many companies is well below the 6 to 7% nominal GDP number. In fact, we're seeing negative top-line numbers out of a lot of the retailers. On a year-over-year basis, their sales are down. So again, probably an indication of how the consumer is feeling. What is helping to make sense about all these contradictions is an identity I mentioned in the last in the know, and that is GDP growth versus GDI growth. GDP is gross domestic product, so consumption, investment, government spending, and trade, or net exports, and then inventory changes. On the other side of that, the identity, gross domestic income, is simply the various income reports out there, wages, profits, and so forth. And those statistics are more reliable in the short term, whereas gross domestic product gets revised, sometimes quite dramatically around turning points in the cycle. Gross domestic income does not, or is revised much less so.
As growth in Europe substantially weakens, the U.S. has recorded a 2.1% annualized expansion. That figure for the second quarter, coupled with signs of labor market weakness, has raised hopes of a U.S. soft landing, taming inflation without a recession. With both corporate and personal incomes hit harder in Europe, businesses and households have fought harder to resist losses than in the U.S., embedding inflation deeper. Policymakers and economists across the U.S. are more optimistic about the trajectory for inflation, too. Most expect price pressures to continue easing, at least in the coming months, as demand moderates, lingering supply snarls unfurl, and the labor market continues to cool. Let us get back into the video as Cathie Woods now explores the various marker signals.
The best sector has been energy. Energy prices have gone up. We got some data from Saudi Arabia today, or on Saudi Arabia and Kuwait. Their exports have collapsed. They've gone from, in the case of Saudi Arabia alone, I think roughly a 7.5 to 8 million unit barrel range down to 5.5 million. I mean, that's unbelievable, especially because at these prices, even at these prices, it was break even at the prior level of production. So it's probably in a deficit position, and we're marveling at the prices it's paying to attract sports franchises. So, that's a big disconnect out there. Nonetheless, energy sector was the best. And, if Saudi Arabia is going to normalize its production schedules, which it will have to pay for all these sports franchises, we believe that energy prices will come down, especially as electric and autonomous make their way into the system. Healthcare and communication services were the next best. And while energy was up, healthcare and communication services were down. On the other side of the ledger, interest rate sensitive stocks and categories were hit hardest, utilities and real estate, because the 10-year treasury yield, because interest rates went up. The other category that was down, and this is surprising when the market is in a weak spot, consumer staples tend to outperform. They did not this time. And I think it is because of what I've mentioned about their pricing power, at least the power they thought they had, really diminishing quite significantly. In the beginning, the market is beginning to understand that. Fixed income, as I mentioned, interest rates went up, hurt those interest rates sectors, but it was a really important test. We really didn't make it past the peaks from October of 2022. Now, what is the similarity between now and then? Back then, the Chinese yuan was depreciating at a rate that the Chinese government did not like. And so it started selling our bonds, and its reserves have actually been going down. Its dollar reserves are down from a peak of 1.2 trillion to 834 billion now. And the reserves are dropping 10 to 20 billion a month. We believe that this last month, which is when the yuan went back to the level where it was last October, that the PBOC was selling its dollar reserves aggressively in order to get dollars to support the yuan. And so we wouldn't be surprised to see a very big drop.
The Bank of Japan will be able to gradually shift away from its easy monetary policy only after ensuring its 2% inflation goal has been sustainably achieved, former board member Goshi Kataka said on Monday. Kataka expected the spring 2024 wage negotiations to be key for the Bank of Japan's inflation mission. Kataka, currently chief economist at PwC Japan, told the Reuters Global Markets Forum. Next year's wage negotiations will require nominal wages to rise at least as much as this year's to confirm a virtuous cycle of income, spending, and prices, he said, adding an exit from easy policy won't be possible until after next year. Once it begins exiting policy, Kataka expects the Bank of Japan to first remove the peg on the 10-year Japanese government bond yield, then exit its negative interest rate policy, and finally scrap the yield curve control policy. Kataka described the central bank's move in July to allow long-term rates to rise more as a bad decision, saying there were no particular distortions observed in the bond market, unlike in December 2022, when the Bank of Japan made a surprise tweak to its bond yield control under then-Governor Haruhiko Kuroda. Allowing the guide rate to effectively go as low as 1% would not be possible until the 2% inflation target is achieved, Kataka said. The Bank of Japan said the July action was aimed at making its yield curve control more sustainable, but markets saw the move as another step towards the central bank dialing back its massive stimulus program. Kataka said a recovery in Japanese production and domestic consumption was still only gradual, and that the government had not been very active in increasing the public's disposable income. The Eurozone's headline rate of inflation stalled at 5.3% in August as rising fuel prices and the removal of electricity and gas subsidies in countries like France caused energy inflation to rebound. Core inflation, excluding energy and food, declined slightly in Europe's single currency bloc, but at 5.3% it has only returned to its level at the start of the year and remains close to a record high set in March. What do you think of the Cathie Wood's macro outlook of the economy? Let us know your thoughts in the comment section below. Also, don't forget to hit the like button, subscribe, and turn on notifications. Thanks for watching.